you're going to have to file come this following tax season. So major moves that you can make before December 31st that will result in some very major tax savings. So once again, I've been working for Bob Hall going on 16 plus years now. I prepare individual and business tax returns. We are an award-winning law or tax firm, and I'm also an award-winning accountant. I bet you didn't know there were awards for accountants in the Glendale area, but I'm also the keynote speaker, and I speak at over 100 plus events per year, and have been doing this for the speaking events. I've been doing this for about 10 or 11 years, but preparing taxes for 16. And like I said, I do anything from individual to business to trust to nonprofits, you name it, we file it here at Robert Hall. I by no means am a one-man show, though. We have about 16 senior preparers on staff now, and we prepare taxes in all 50 states. So even though we only have one location here in Southern California, we file taxes in all 50 states. And I'm not just saying that because we file taxes elsewhere. Literally, we have clients physically present in each of the 50 states. So if you have investments outside of California that you have questions about, I'm not going to sit here and pretend to know every single intricate part of every city tax code across the US, but for the most part, all of the state tax codes, we know the ins and outs of each state. So at the end, I'm going to remind you about our free consultation, but I did want to mention that first and foremost, that at the end of this webinar, if you do have questions and you're not able to get the answers to those questions in this webinar, we do offer free 30-minute phone, Zoom, or FaceTime consultations, and I'll give you all of my contact information towards the end here. So why the heck are we here today? Why the heck are we here to talk about a year-end planning scenario? Why is it important to know my tax situation before this specific deadline? And what are these deadlines that we're talking about? Because when we think of year end, we think of December 31st. We think that that is going to be the end of our calendar year, which is absolutely 1000% correct. That means that any major deduction you are spending your money on has to be expensed before December 31st in this, what we call calendar year, January 1st through December 31st. But April 15th is being a deadline of tax liability deadline is a general misconception, because April 15th is actually a filing deadline. It's not a deadline to pay tax. October 15th is the extension deadline. Your entities, corporations, and partnerships, they have a deadline of March 15th or September 15th. And those are only deadlines to file your tax return. So the reason why we're doing year-end planning is, one, to put a plan in place to ultimately not fail when it comes time to file our tax returns, right? Failing to plan will ultimately be planning to fail. And this plan is meant to not only give you peace of mind, but to set you up to not have to pay unnecessary penalties and interest on any current liabilities that you'll owe with your tax filing. I'm going to give you a personal example and a professional example. Personally, as a real estate investor, as a business owner, and as a W-2 wage earner here at Robert Hall, I choose not to pay my taxes until I actually file my tax return, which is fine. And I always get hit with a little bit of interest and penalty amount, but I'll tell you what happens when you take this approach. As long as I put my money to work for myself throughout the year, as long as my ROI, my return on investment, is greater than the 2 or 3% penalty and interest I pay when I file my tax return, I figured that it was a better financial move for me to keep my money rather than prepay it to the Uncle Sam and to the state of California. Now, as a tax advisor, I have access to my software program 24/7. So for me, it's a little bit easier to play that game. I do have other real estate professional clients who play this game, much like I do, who consult with me throughout the year, maybe 3, 4, 5+ times throughout over an annual period. And they like to play it pretty close to the chest because they know that cash is king in their industry. They need the cash available to make significant moves. For those individuals, they understand the risk. For the general public, for individuals who never want to owe the IRS, who actually never want to get refunds back, but they just want to break even at the end of every year, that's also the appropriate approach as well. I understand completely that people don't want to pay a single dime more than what they owe. The issue with that is that you're not going to have all that freed up cash throughout the year. So there are different approaches. The reason why I'm explaining these to you is that there are options and there are different approaches that people take to tax planning. But at the end of the day, the number one goal for all of us is to pay an obligated amount of tax and not a penny more than that obligated amount, by being safely aggressive and not overly aggressive. I tell clients all the time that there is very much a significant difference between being safely aggressive and overly aggressive. Sometimes I see clients being very, very aggressive with certain deductions, restructuring their business. And at that point, I tell them, hey, let's pump the brakes for a second. Maybe we can achieve the same results by doing things this way, which is more safely aggressive than the latter. So just be aware that planning ahead will put you in a power position. I call it a power position to essentially pay your obligation in tax and not a penny more than that obligated amount. So that's the goal through year-end planning. Right now, because October 15th has passed, that was the deadline for 2019's individual tax filing season. So 2019 is gone in the wind. It's gone. It's behind us. So we have to look forward. We have to look for 2020 and what potential changes could be on the horizon for 2021. So right now in our office, all of the consultations that we are currently seeing, well, not seeing in person, unfortunately, but by phone and FaceTime and Zoom, we are sitting down with our clients and reviewing either their paycheck stubs to see what they've currently paid into the system, or if they're self-employed, seeing what their overall net profit is year to date. Meaning that the review, the year-end planning session for an employee is going to be much different than the year-end planning session for a self-employed business owner. See, for a W-2 wage earner, it's pretty easy for me to project what my liability or what my refund would be if all I had was W-2, right? I take my current paycheck stub, I take what my gross revenue is on the stub, my gross federal taxes and state taxes paid, I divide it by whatever month we're in. So if we're in October, I divide it by 10 months, multiply it by 12 to give me a projection over 12 months. And that will essentially tell me what my annual revenue will be and all of the taxes I've already prepaid. So pretty straightforward. It takes about 10 minutes to calculate a W-2 wage earner's year-end review session. But for a self-employed individual, it works a little differently. So when we sit down with a business owner or someone who has rental investments, we need all the pieces to the puzzle in order to accurately calculate some of these numbers for the client. We need year-to-date income. We need year-to-date expenses, and that will give us what your year-to-date profit will be. And that profit number tells us exactly where you are going to file, how much income you're going to be filing, and projecting what liability you will owe based on having to file with that level of profit. But then we also need all of the other parts. You know, if you have retirement income, or if you're collecting Social Security or unemployment income, or if you own a home and you have mortgage interest and property taxes. So we need all of those pieces, not exact figures, but rough estimates for year-end planning so that we can make a prediction essentially, or project what your potential liability or refund will be well before the year is even over. And once again, this puts you in a power position to know and give you peace of mind to know exactly what you're going to owe Uncle Sam when it comes time to actually file your tax return. The government requires you to cover one of two numbers in liability before the end of every fourth quarter, every year's fourth quarter. And some of you might be thinking, okay, well, that's December 31st. And actually, that's not the end of the fourth quarter. The end of the fourth quarter is actually January 15th of the following year. So there's always this like 15-day buffer into the following year where the government allows you to make the last quarterly payment, not by December 31st, but by 15 days into the following calendar year. And so you have to cover one of two numbers, one of two liabilities by that date, January 15th. And the second bullet point here states that 90% of either your current year liability or 110% of your previous year's liability, in most cases, whichever is greater. Obviously, if your income jumped from $50,000 to $500,000 in a year, covering 110% of your previous year's liability, probably not going to cover everything for penalties and interest because your income significantly increased. And that is a perfect example of someone who would need to sit down before the end of the year and map out a plan to try and reduce that liability as much as possible. Maybe going out and making a major improvement to the rental property before December 31st to reduce cash flow and taxable income. Maybe going out and purchasing a work vehicle for the business and accelerating some of the depreciation write-off, if not all of it in certain instances. These are great ways to reduce taxable income in the calendar year. Above and beyond that, though, you are looking for deferred comp plans, solo 401k, self-directed IRA investments. You're looking for ways to further reduce your taxable income just so that whatever that bottom line is, you know you've done everything within your power to get down to that obligation and tax amount and not a penny more than that obligated amount. So we're working with both right now. We're working with employees and with self-employed business owners before December 31st to give them peace of mind as to where they're going to be sitting come tax season. And like I said, 2020 has been a very unique year. I have clients calling me saying, Tony, I've made triple the revenue this year because as soon as the economy was back up and running, I was ready to go. I'd been doing Zoom seminars and via, GoToWebinar and all of these ways to digitally connect with clients. And so some clients have had pretty darn good years so far. I'm not saying everybody has, but for those of you who have had great years, this might be a perfect time for you to sit down with a tax professional and do some serious year-end planning. Let's talk about some of the tax deductions you really need to maximize before the end of the calendar year to make sure that you are retaining most of your wealth. Remember that what we're talking about today is tax planning, but I look at it from a couple different perspectives. I look at it obviously from a professional standpoint as planning to pay less tax. But also as a business owner myself, as somebody who does year-end planning for my own businesses, I also look at it as a way to retain wealth, right? Because we don't work a full year to make money and then to just pay it all back in taxes, right? We work all year to make our money, and then we want to do whatever we possibly can within our power to retain as much of that wealth as possible. So I find that tax planning is also a very, very key strategy, a very key point in planning to retain wealth. I also think of me saving $10,000 in tax as me getting a $10,000 bonus, because instead of paying Uncle Sam $10,000 through proper tax planning, I was able to keep that $10,000. So that's, you have to sometimes train your mind to think that way, because it could be a simple difference of you actually making more money in this year just by planning ahead to pay less overall tax. Remember, tax evasion is illegal, but proper tax avoidance is not. And so through proper planning, you can avoid paying unnecessary tax and just to pay your obligation in tax and not a penny more. So top 5 tax deductions right out the gate: marketing and advertising expenses, professional supplies and equipment, car and truck expenses, legal and professional fees, and property deductions. Now I'm going to go into more detail about property deductions in the next slide, but I did want to cover the first 4 really quick. Marketing and advertising, one of the most common deductions, especially if your business continues to progress in an upward trend over the years. I can tell you right now that if your business goes from $50,000 in revenue one year to $200,000 in revenue the following year, and you have 0 in marketing and promoting and advertising expenses on your return, the potential for audit risk actually increases for you, because the government's going to wonder what you did in your own financial world to increase your revenue from 50,000 up to 200,000 without doing a single piece of marketing or advertising, without having a single expense in the marketing field. Now, it's probably an easy explanation. Maybe you inherited some money, and so you reinvested back into infrastructure or hired people, and you were able to service more clients. That's an easy explanation. But not everybody has the opportunity to explain that to the IRS before they pull your return for audit, right? So what you want to take a step back and look at is, okay, well, how has the progression of my business really happened, and what has caused that progression? What things have I spent my money on over the past 2 or 3 years that the government's going to look for as an ordinary, necessary, and legitimate expense? Marketing and advertising happens to be one of the most common deductions, especially in today's day and age, and probably most specifically for 2020, because you can't go out and meet people and shake hands and advertise that way. You have to go online and pay for online advertising and webinar servicing fee, all of these things that are coming into, and I call them pandemic expenses, because they have been fueled by the pandemic. So the government's going to look for this specific write-off on your return, especially if you see a progression in overall business revenue or rental income even. If you have a vacancy during 1 month or a couple months, and then you put somebody back in that property a couple months later and you charge them more. Well, how did you get that client in there? Was it a referral? Okay, well, that's an easy explanation. But did you have to advertise on apartments.com? Did you start Airbnb and VRBOing it and advertising it that way? So there are a number of situations, a number of options that you have for those particular write-offs. Probably the deduction with the lowest risk for audit is professional supplies and equipment. I don't know too many people in today's world that can do business without a laptop. I don't know too many people who can do business in today's world without a cell phone. So you're looking at some of the most common expenses that a business will have or incur on a year-to-year basis. Supplies and equipment, in most cases, dollar for dollar tax deductible. The only time that you'll run into a little bit of a limitation is if you go out and you purchase a tangible asset like a computer. You actually have options of how you can write that expense off. The federal government says that a piece of equipment, for instance, has a 7-year lifespan. So you can either choose to depreciate the asset over 7 years, or you can make an election to accelerate the deduction and take it all in 1 year. It's called Section 179 deductions. And so that's an election that you make on your return to accelerate the write-off. So there are options that you have with furniture, with computer equipment, with cell phones, tablets, whatever you're utilizing technology-wise or furniture-wise to develop more business and obviously reinvest back into infrastructure. Great overall tax write-offs. In 16 years that I've worked in the tax industry, I have yet to see an audit on a computer purchase. Just saying, that has a very low risk for audit. Car and truck expenses, a very, very particular part of the code that tends to have more questions than the latter. Car and truck expenses are very unique. I'm going to be very broad with my explanation of car and truck expenses because everyone in today's webinar, I think 43 attendees today. Great to see you all. Thank you so much for taking time today to be here. Everyone will be impacted or affected differently with their car and truck expenses. Some of you may opt to lease a car. Some of you may have gone out and purchased a vehicle. Some of you might be self-employed. Some of you might be employed. Some of you might opt to take the mileage write-off because you've driven a same car for the past 15 years. Some of you might have had to rebuild an engine this year, so you opt to take actual car expenses over the mileage deduction. So everybody has a different scenario. Everyone's tax return is unique and different in different ways. So car and truck expenses will impact each one of you differently. And that's why I want to leave you with this, that you need to have a specific conversation with your tax advisor about which direction you should go in or how you should utilize this expense to further reduce liability. One little snippet that I want to leave you with as well on car and truck is that as of 2018, for the purchasing of an asset, for the purchasing of a vehicle, not leasing, not a car that you already own, but if you go out and you purchase a new vehicle, as of 2018, the government has brought back something called bonus depreciation. And bonus depreciation is very unique because if you buy a car based on class weight, meaning that you're buying a sedan or a smaller car that weighs under 6,000 pounds. It's a very specific number, but if you purchase a vehicle that's under 6,000 pounds, in the first year of your business purchasing this asset, you potentially could receive up to an $18,000 bonus depreciation write-off in the first year of purchasing. That means that you didn't have to buy the car outright. Literally, you walk onto a dealership or a dealership lot, you put $5,000 down on a vehicle, or you don't have to put anything down, and you finance the whole purchase of a Honda Accord for $35,000. Under your business, you get an upfront $18,000 write-off for purchasing that business asset, whether you paid it outright or not. Because right now, what you did is you acquired an asset, but you were using somebody else's money to purchase it. It doesn't negate the fact that you actually purchased the asset. So cars under 6,000 pounds, $18,000 upfront depreciation write-off. It's great on the federal return. California does not allow for that benefit. If the car weighs over 6,000 pounds and you purchase a vehicle for business use, it potentially could qualify for something called 100% bonus depreciation, meaning that a Chevy Silverado, a Chevy Tahoe, a Tesla Model X, a Range Rover, if it is purchased under a business or for sole business use, those cars, because they weigh over 6,000 pounds, could potentially receive a benefit of 100% deductibility, which means that if you have $100,000 of income on your federal return, self-employed income, and you buy a $100,000 vehicle over 6,000 pounds, you potentially could wipe out 100% of your profit all in that 1 year because of the bonus depreciation. So once again, there are a couple other things that need to be discussed, and that could probably be a whole hour webinar just in itself. These are important conversations for you to have with a licensed tax advisor. If you don't feel like your tax advisor would know the answer to this, once again, I'll remind you again at the end of today's webinar, we offer free consultations. And I would highly suggest that you utilize that consultation to ask us these very important questions so we can get you the answers to your questions. Legal and professional fees for the self-employed, for the real estate property investors, legal and professional, great dollar for dollar write-offs. Nothing's really changed there. The only thing that has really changed with a lot of these write-offs is that if you aren't self-employed or if you don't have rental investments, a lot of these expenses for W-2 wage earners, if that's the only income that you have, won't be tax deductible. As of 2018, W-2 wage earners are not allowed to deduct unreimbursed business expenses on the federal return. California still allows them as write-offs, but the IRS no longer allows those as write-offs. Once again, unless you are self-employed or unless you have rental investments. So just be aware that some people will take these deductions, others will not qualify for these as overall legitimate deductions or allowable deductions. Property deductions. So one thing that we need to jump into when talking about property deductions is the differences between a primary residence and a rental property, right? Because the deduction for property taxes and mortgage interest and improvements and insurance and depreciation, it changes whether it's a primary residence or a rental investment. See, when you rent out a property, guess what? You own a business. See, the definition of a business, just from a financial standpoint, is something that generates revenue and has overhead, right? Well, a rental property has revenue and it has overhead. So it's a business. It's not a self-employed business because it's not subject to self-employment tax, but by definition, a rental property is a business investment. And so with a rental investment, there really are no limits to what you can deduct. I mean, if you have $100,000 in mortgage interest on a rental investment, guess what? You're going to put the full deduction on your return. You have $50,000 in property taxes on a rental investment, you're going to put that on your return. On a primary residence, it's much different. So this is all still part of the top 5 tax deductions. On a primary residence, you will only be allowed a mortgage interest write-off and a property tax write-off. Now, under the new tax bill, as of 2018, the tax reform bill of 2018, yes, there are limits in place that will limit the amount of write-off you get for each one of these expenses. But a lot of individuals didn't realize that dating back even before the 2018 tax reform in 17, 16, 15, 14, gosh, all the way back to probably the mid 90s, mid 80s, there was already a limit in place as to what you could deduct in primary residence property taxes and state income tax. If I could ask you to raise your hands, I'd ask how many people knew that. In a lot of cases in my in-person webinars, a lot of people didn't know this. Why would you know it? You're not a tax advisor, right? You're not a tax preparer. You don't study this stuff. And so under the old tax bill, there was something called AMT, Alternative Minimum Tax. And some of you might be saying, oh, yeah, I know about AMT. Well, AMT was actually a limit that was already in place and has been in place since the mid 80s that capped or disallowed completely your primary residence property tax deduction. Sounds crazy, right? You probably didn't know that there was already something in place that might have disallowed your property tax write-off completely. See, in 2018, it was only that part of the tax code was only defined more clearly. Even though there is a $10,000 cap on your property tax and your state income tax deduction as of 2018, what they changed part of the Internal Revenue Code to, or what it was affected by the new tax code, is they removed alternative minimum tax, the old limitation, and bumped the threshold for AMT up to $700,000. Now, what the heck does that mean, Tony? Because you're speaking, a different language now. Well, all you have to understand is that under the old tax bill, if you were making over $275,000 roughly, you were already limited to what you could write off in your primary residence property taxes. In fact, at about $300,000+, most of you probably weren't allowed any of it as a write-off anyway, because of what I call the AMT sponge. The sponge sucked up and soaked up and became fully saturated with all of your property tax and your state income tax write-off. And the only way to wring out that sponge was for your income to drop below $275,000. Otherwise, for however many years, 15, 20 years, you may have been subject to this alternative minimum tax and never been allowed your primary residence property tax deduction. As of 2018, AMT doesn't kick in at 275 anymore. It kicks in at roughly $700,000+. So some of you, even though there is a cap under the new tax bill at $10,000 for property tax, some of you, because of the change to AMT, might actually be gaining a $10,000 write-off. Because under the old tax bill, you weren't allowed any of it. And now under the new tax bill, because you're not subject to AMT anymore, you're actually gaining somewhat of a $10,000 tax write-off. The reason why I'm going into detail about that is to show you, one, how complicated the tax code is. Number two, how the tax code will impact everyone in a different way. Just because the tax code impacted your neighbor in a negative way doesn't mean that it's going to impact you in a negative way. Just because it impacted you in a positive way doesn't mean that it's going to impact somebody else in a positive way. So do planning based on your specific scenario. Do not do planning based on what your neighbors or your coworkers, or your family members, or your friends have told you about what the tax code will be bringing or has in store for you, okay? So plan on your own. The power of planning, POP, we call it. The power of planning is just such a huge tool and position for you to put yourself in that will allow you to retain, once again, more of your hard-earned revenue, retain more of your own wealth. Let's talk about self-directed versus traditional retirement investing. One big part of year-end planning is not only to figure out the deduction side of things, but once we've come up with all of your write-offs, once we've actually spent all the money that we need to spend, reinvesting back into business assets or prepaying some things that you're going to be expensing in January, but expensing them this year instead. Another big part of year-end planning is to try and figure out what your allowable deferred comp contribution will be. Meaning if you want to contribute to an IRA or a 401k, we need to map those numbers out well before the end of the year to make sure that number one, you have enough cash to make that happen. And number two, if it even makes sense to do this. See, at the end of the day, if you spend all of your money, if you reinvest all of your money back into infrastructure and you have no taxable gain, why would you ever invest in a retirement account? I mean, you really can't because you have no revenue to defer, right? You're already at a 0% tax bracket. So we always look at ROI, right? ROI is key. Cash is king. ROI is king. Return on investment. Well, if I'm in the 2% bracket, why would I ever lock $19,000 into a 401k if it saves me 2 cents on the dollar? It wouldn't make sense for me. I'd rather keep that liquid and invest in other ventures, syndications or note investing. There's a lot that you can do with your money. But if I am making $200,000-$300,000 a year and I'm in the 24 to 28% bracket, let's say, it makes more sense to put money into a retirement account because every dollar I defer into my own retirement is saving me 24 to 28 cents on the dollar, roughly, maybe even more, depending on what state you're investing in. So these are very integral parts to year-end planning. But what you need to realize about retirement investing is that you don't have to plug your money into the stock market. You can actually set up self-directed retirement accounts where you control where the money is invested, meaning that a self-directed retirement account can invest in notes. A self-directed retirement account can invest in syndications. A self-directed retirement account can buy rental investments. I mean, essentially, the ups and downs of a self-directed retirement account are the ups is that you have full control over what you can invest in. The downside is that if you don't invest in anything, it's not making you anything, right? You got to put the money to work in order for this venture to make sense. I always tell my clients, let's diversify, right? Because myself as a real estate investor, as a stock account owner, as a W-2 earner, as a business owner, I diversify. So I have a little bit in the market. I have a heavier on the real estate side, but I diversify my retirement because I know that I have control over certain things and I don't put all of my eggs essentially in one basket because we know if that basket ever fell through or the bottom fell through, all the eggs would break. And then I'd be in a real mess, right? So diversify amongst these different type of investment vehicles. Solo 401k and self-directed IRA investing has been around since the early 70s, 1974, I believe. So it's been around for a very long time, but it's only recently over the last 10 plus years become a very popular topic to discuss. Wall Street for a very long time did not want you investing your retirement in real estate. But I do know one thing about real estate as a real estate investor myself. I know that whether the economy is good or bad, in the midst of a pandemic, even, I know it's hard to kind of find the silver lining in everything right now, but whether the economy is good or bad, people will always need a place to live. They will always need a place to live. Whether the economy is good or bad, people will never be, or the properties will never be worth what they were in 1950, 1960, 1970, 1980, 1990, and going on and forward. But what I'm trying to get at is that property is always going to be, number one, the greatest tax shelter you can park your money in. And number two, it's always going to be the most consistent dividend, long-term appreciating asset that you can park your money in. It's just a great tax shelter, a great overall investment. And like I said, whether the economy is good or bad, people are always going to need that asset. So diversify and learn more about the different options that you have and that are at your fingertips for investing purposes. Now, some of the results of the pandemic with the IRS layoffs, at least towards the beginning of the year, I know the IRS has really started to ramp up their employment again, but the IRS is still about 4 to 6 months behind in processing. So at one point during the year, they were 8 to 10 months behind in processing. So if you are, and we're looking at a little bit of an uptick in COVID-19 cases again. So we don't know how long the IRS will continue to staff all of these individuals. I know they've tried to do things remotely now, but if you think about it, how can you send 1,000 IRS agents home with access to people's social security numbers, tax returns, so on and so forth? They're not going to do that. I know they're following CDC guidelines, but these IRS buildings that people work in, they're all in cubicles. They work in very close-knit quarters, close quarters. And so we don't know if they're going to have another mass layoff between now and when we actually get a hold of this virus situation. So just understand that there are longer processing times, erroneous letters that you may have received, incorrect assessments, lender borrower complications where you've submitted a return, but it hasn't been fully processed yet. And the lender is wanting that processed return to qualify you for a home loan, and also delays on the tax preparation side. When we submit a document to the IRS, we're not going to be able to call 2 weeks from now and get an answer. That's just unfortunately one of the results of the pandemic. So have patience with all of this. We will get through this in one way or another, and we'll come out the other side knowing a little bit more about this virus than we knew, obviously, going into it. But just have patience with all of this, and also work with somebody who understands ways to get things pushed through. Because I'm not saying everything is delayed. I'm just saying that there are certain things that probably will cause a little bit more wait time for you as the taxpayer than it has in the past. So one thing that I did want to touch on with regards to the entity selection side of business is when you're planning to protect assets, especially in times of economic uncertainty, you're not only looking for great insurance policies to be in place, but you're also looking for entity selection benefit, meaning that you want to separate your business assets from all of your personal assets. And asset separation equals asset protection. Now, most of you have heard of an LLC before. Some of you might even think that LLC is a corporation. And I want to mention really quickly that LLCs are actually not corporations. LLCs are companies. That's why it stands for limited liability company. When you sign into a lease agreement, when you sign a contract to buy a property or flip a property or to loan money out, if you tell somebody that you are a corporation, that you are a limited liability corporation, which doesn't exist, you may be in breach of malpractice. And here's why. A corporation is owned by shares, not by percent. An LLC is owned by percent, not by shares. Now, LLCs are great for holding large depreciable assets in. They actually limit liability on some of the largest assets that you and I will ever own in our lifetime, like property. And so they're great for long-term rental investments. LLCs are not necessarily great entities for self-employed businesses. If you're making under $35,000 to $40,000 as a self-employed business, LLCs are great for limiting liability on the business, but they will save you absolutely nothing in tax. Once your business starts to generate revenue above $40,000, even if you have an LLC set up already in place, you may want to, per the advice of a tax advisor, convert your LLC into a different type of entity that will allow for both the asset protection benefit and tax savings benefit. So when you have an LLC, don't think, oh, well, Tony, you just told me that there's no tax benefit. Well, don't think that you're out of luck just yet. LLCs can convert themselves to S corporations, which happen to be the only entities under Internal Revenue Code that can actually save you tax. Except, like I said earlier, it's only going to be a benefit for the self-employed business owner, not so much for rental property owners, because rental income does not pay self-employment tax. So to kind of summarize, rental properties, LLCs, self-employed business, LLC or S corporation, depending on where the net revenue is. So let's say that your numbers make sense enough to have the LLC and then to convert it to the S corporation. How does the S corporation actually end up saving you tax? Well, the S corporation doesn't actually save you federal or state income tax, but what it does help reduce is the amount of self-employment tax that you pay because you're self-employed. And this is essentially how it works. Let's say that your business is generating roughly about $100,000 a year. On $100,000, you're well above that $40,000 threshold I mentioned to qualify or benefit from being incorporated. And on $100,000 now under an S corporation, you are no longer considered to be self-employed. And so right before the tail end of the year, you have all of this revenue that you're looking at and you're thinking, well, I want to make sure that I'm set up correctly to reduce liability. This is a perfect conversation, a perfect time to have this conversation with a tax advisor to see if we can get something in the pipeline as far as an incorporated entity is concerned, do a redirect of income into the corporation and play what's called the reasonable salary game. Because as a corporation, you are no longer self-employed. You are actually an employee, or you become an employee of your own corporation. So on $100,000, you have to pay yourself a minimum salary of 40%, which is $40,000, easy to calculate off of, and you get to write yourself off. You get to write your payroll as a deduction against your $100,000 of income. So 100,000 minus 40,000 gives you $60,000 of leftover profit. Like I mentioned earlier, tax evasion is illegal. Proper tax avoidance is not. And what you've achieved in this particular situation is you've properly avoided paying self-employment tax on $60,000. Because in this situation, now that you're an employee, you don't pay self-employment tax, do you? You pay payroll tax. And you only pay payroll tax on the $40,000 salary. On $60,000 that's left over, which is yours, you can take that money from your company at any time. What you've avoided on $60,000 is 15.3% of self-employment tax. That is overall a tax savings of roughly $9,100, $9,100 in overall Social Security and Medicare tax reduction. And so once again, the Power of Inc. is a whole probably 2-hour webinar just in itself, but I did want to mention this just so that you know that, hey, if those numbers make sense, if you're kind of at that threshold, maybe it is time for me to jump through that hoop or take the next step to incorporate my business. But you have to go with a tax professional who understands how a corporation operates, why you would want to be one entity over the other. All right. So make sure that you have this conversation with your tax advisor. We're going to get to Q&A in just a second, guys. I promise I'm not going to leave those questions out. A couple smart applications that I want you to be aware of that are out there and readily available to help you and assist you in your day-to-day operations. Mile IQ is a great app to track your mileage for tax deduction purposes. It actually has been used in audit situations to prove that the mileage deduction is ordinary, necessary, and legitimate. Track My Corp, if you are incorporated as an LLC, as an S-Corp, or a C-Corp, you may have received correspondence at any given time from the state of California. You may have made a payment to the state of California late and been assessed penalties and interest. You may not have renewed your Secretary of State statement of information before. And so, you know, a lot of the confusion and kind of the stresses of operating a corporation is all of the correspondence that you'll receive. Well, Track My Corp actually is a reminding application that reminds you about upcoming deadlines, not to file them for you, but just to tell you, hey, your corporation has a December 31st year end. You might want to call your accountant to set up a year-end planning appointment. Or, you know, April 15th is right around the corner. You'll owe your $800 California filing fee for the LLC. Don't forget to send that in. So it's a reminding application that tells you about a lot of these very important upcoming deadlines. Mint.com actually should take the place of a very small-time bookkeeping service. It's not meant to do full-blown bookkeeping for you, but it is a very cool program that you can link up to your credit card statements and your debit card statements. And whenever you swipe your card at a Shell gas station, Mint will allocate that expense to auto and truck. If you swipe your card at a Staples, it'll allocate the expense to office or home or supplies. So you get what I mean. It's basically an algorithm that's part of this program that will help allocate your expenses and organize them for you without having to pay thousands of dollars for a personal bookkeeping service each year. Some very cool smartphone apps and smart device apps that you can take advantage of. And whatever you end up paying for them, hey, guess what? It's a tax write-off, which is great. So utilize those smart device apps to make your life a little bit easier. Obviously, we covered a lot today. We're going to go over Q&A in a second. If for some reason you have to jet off the call today, we do offer free 30-minute in-person, normally in person, but because of the pandemic, we're doing mostly everything by Zoom or FaceTime or phone. Free consultation, 30-minute consultation to review past filed tax returns, so 2019, 2018 returns, to check for possible audit triggers on your return. If we need to correct anything on a previously filed return, we'll go ahead and do that as well. And then also to add you to our periodic tax email updates. We have an election coming up in a week, you know, and so a lot might be changing. And then we also have a second stimulus that we'll be passing over the next month or so. And so there's going to be a lot of Q&A around that. We'll probably put together a whole new webinar for those specific changes. But that tax email update will let you know when a lot of those changes occur. And so in order to get set up for this free consultation and to be added to that email update list, that will also notify you about upcoming webinars, you can go directly to roberthalltaxes.com/consult. You fill out your information. Don't click the screen because this is not an active screen here. You actually have to open up your web browser and go to www.roberthalltaxes.com/consult. You fill out your information. It submits you for the free consultation. We'll get you hooked up with that free consultation with one of our senior preparers as soon as possible, hopefully within the coming week. If you want to call directly into our office, 818-242-4888. And I will also type my email and my phone number into the chat box in case you'd rather sign up that way with email. But the best way to get answers to questions outside of today's webinar is to get you set up with that free 30-minute consultation. There's no hard sell. If you're looking for a new accounting firm, give us a try. We're here and readily available to assist. And obviously, if you're currently with an accountant that you've loved and adored for however many years, eventually your accountant will retire, right? Or move and not be able to service your file anymore. So keep us in mind for any future endeavors and future service needs. Okay. Let's hop into questions, I guess.
Absolutely. And everybody, let Tony and Robert Hall know that you were on this webinar, and let them know where you came from, you know, because they like to be able to track that they're doing good work.
Sure. Absolutely.
Absolutely. So, all right. So a couple of questions going back to some of the car deductions. So what if you use your car for business and personal, and does the vehicle have to be registered in the name of the business?
Great question. So when you deal with cars and business deductions, if you have a car, one car, and that's all that you own and you're a single person, you can't say that it is 100% used for business. Even though it's an ordinary business expense, it's necessary, it's legitimate. Above and beyond, the government doesn't find that to be a reasonable allocation. So you have to have a conversation with your tax advisor about what timing or what percentage is used for business versus personal. Average percentage breakdown in real estate is normally 65% business, 35% personal, but it really all depends. I have a lot of real estate professionals who really don't travel for personal use that often because they're working 24/7 year round to build wealth. And so a lot of times they will push that envelope and maybe go up to 70-30 split, but industry average is between 65-35 and maybe 60-40 for business and personal use. That's for real estate industry specific professionals. If you are a medical professional and you're self-employed or a partner of a, Kaiser or something, medical professionals tend to not really have that much mileage, unlike real estate professionals. So if you're trying to write off a vehicle as a medical professional, you would probably lean more towards 40% business, 60% personal. And I'm not making this up. This is actually all based on case study in audit scenarios with the IRS. They look at industries differently. Why would an accountant have 70% of the time used for business, right? I don't travel at all. I drive to my office and I work from my office and I drive home. So if an accountant in the financial industry is saying that, well, I use my vehicle 80% of the time for business, that's probably going to be a little bit of a red flag because the government knows that in the accounting industry, accountants don't drive that much. So once again, it's all industry specific and also very much scenario specific. So I'd say probably having that conversation with your tax advisor is the best start to that conversation. So that's dealing with the allocation. And then there was another one for titling under the business. So if you purchase a car personally and you use it for both business and personal, it's okay that it's titled under your name, but you're going to have to allocate the business versus personal use. If you have a corporation and you purchase a vehicle under the corporation, meaning you title it under the corporate name, you insure it under the corporate name, the EIN number is the registered ID number to the business vehicle, that is actually a corporate asset. So therefore, it is not a personal asset and will qualify for 100% deductibility under your corporation. Now, there is something called a pass-through or a reach-through grab by the IRS, meaning that if they audit your corporation and they find that you've been running personal expenses through your corporation, they could reach through to you personally and see if you have any other vehicles. Meaning that if you don't have any other vehicles and you solely use your corporate vehicle 100% for your, or not 100%, but you use the deduction that you took 100% for both business and personal, they could actually limit that write-off at the corporate level. So once again, be reasonable with what you're trying to deduct and what position you're trying to take. If you own a vehicle personally and your company also purchased a corporate vehicle, great, you get 100% deduction for that vehicle. But if you want to play the game, you got to play it right. Okay. And these are great conversations to have with your tax advisor because it's all a case by case scenario, unfortunately. So I can't really give you a broad kind of general answer to that question. I'd suggest having that consultation with one of our senior consultants and letting us advise moving forward on that.
And Tony, do you find that your clients have trouble as, maybe smaller business owners to actually purchase a vehicle in a corporate name and have it financed in a corporate name? Have you encountered that? Have your clients ever encountered that?
I have, however, a lot of these financing departments are getting very creative with ways to finance deals, because at the end of the day, they do not want you walking out without that vehicle, right? They don't want you walking out of their office without leaving with that vehicle. So, like a perfect example, I just actually purchased a vehicle under one of my corporations a couple weeks ago, and I did not finance it through my business because my business is not 2 years old. My new corporation is only about a year and a half old, so it didn't have any credit. But I was able to personally leverage my personal credit and finance it with a little bit higher of an interest rate. I'm going to end up refining it under my business once I'm able to, but I was able to acquire it with I think a 0.5% higher interest rate over a certain term, but add my company's name to title, which allowed my insurance company to insure it as a fleet vehicle under my business. So once again, that's a very specific scenario. I'm not saying that it's easy to do. Is it possible? Absolutely. But you have to explain that to the person trying to finance it. And yes, you may end up paying a little bit of a premium for that, but the premium will absolutely be offset by the massive tax benefit that you'll get by achieving that deduction under your corporation.
Yep. So it's not an easy process, everybody, but it may very well be worth it.
Absolutely.
Okay,
Once
so
again,
Tony,
case by case scenario too. So case by case.
Absolutely. All right. So does Robert Hall, John asked, does Robert Hall work with real estate professionals so that their status can be defended to the IRS?
Well, absolutely. So any election that we make on our returns, we absolutely represent our clients in front of the Internal Revenue Service. We would never, ever make, just to answer this question specifically, we would never make a real estate professional election without knowing if you 1000% qualified to make that election. The real estate professional election, it has an audit risk of about 75% each year. It is it's kind of the mecca of elections. It is the one thing, it kind of opens Pandora's box, but in a good way, right? So when you check that real estate professional box, you are telling the government that because 51% or more of your time is spent in the real estate world, in the real estate, generating real estate revenue, being part of real estate deals, syndications, actively selling or flipping property or rehabbing property, but that also that 51% or more of your income, not only time, but 51% or more of your income is generated from real estate related activities as well. So when you make that election, you have to be ready to prove that. And we will go and argue this position with the IRS. But if we can't get that proof from you, paperwork, logs, emails, licensing, dues, expenses, if we can't get that from you, we won't have a leg to stand on. And so that's why we need to do a little bit of internal auditing with our clients to make sure that this election is 1000% legitimate. We are not in the business of getting our clients audited. That's 100% true. And I want to be very transparent that we're not like the Wild West. We're not just going to make the election to increase your refunds. That doesn't do you justice. It doesn't do us justice. It only puts you in harm's way. And so if you're going to make that real estate professional election, we will absolutely make it if the checks and balances map out. But also, if the IRS were to ever question that election, we would represent you in front of the Internal Revenue Service and argue that stance. Absolutely.
Awesome. A different John, I took a loan against self-direct. Obviously, I need to make partial payment back prior to the end of the year. I will be taking profit from the sale of a rehab to make the payment. Is this tax deductible?
Okay, so let me clarify that. So you have a self-directed retirement account that is it an IRA or a 401k? Because it depends on how long you have to pay that back. Is it a self-directed IRA?
IRA. Mm-hmm.
IRA. So if it is an IRA, yes, you have a certain time frame to pay that back. Right now, because of the CARES Act, if you were directly impacted by the pandemic, you can actually withdraw up to $100,000 out of an IRA and spread the liability out over the next 3 years. But once again, only if you were directly or negatively impacted by the pandemic. And to be real honest with you, I don't know who hasn't been negatively impacted by the pandemic. So what stands in court, in tax court, we don't have any case study on any of this because it's all brand new. But most people are accessing that money and not paying it back because they're allowed to spread out the liability over the next 3 years. If you're planning to pay it back into your self-directed retirement account, that is not going to be a taxable distribution for you. But if you pulled the money to pay for expenses, rehab amounts on a property, outside of your IRA, yeah, absolutely, that would be tax deductible. And if you put it back, there's no taxable amount. You basically just leverage the money really quickly to make something happen and then put it right back. I don't see any problem with that. But if you're utilizing the money to invest back into the property held by the self-directed IRA, well, none of those expenses are tax deductible because you don't realize any gain or any expenses within an IRA. If you finance the property within the IRA, if you have a loan attached to the property within your IRA, you have something called a UBIT tax requirement, unrelated business income tax requirement, where a portion of your property actually would be taxable gain or taxable rental cash flow. And at that point, you can take a percent of the expenses that you incur on the property that is actually held within the IRA. A lot of moving parts. So I'm sorry I can't give you one just easy answer, but there are a lot of moving parts to that question. That's why that's a great conversation to have, probably in one of those 30-minute consultations. We can absolutely map that out for you.
Yep. Yolanda asked, when is it a good time to move the LLC into an S-Corp?
As soon as the numbers make sense. I mean, there's no harm or foul in converting an LLC to an S corporation if you are a self-employed business owner. If you have an LLC that invests in long-term rental investments, you do not want to do the conversion. Because remember that rental income does not pay self-employment tax, right? So rental property should only ever look for asset protection. Whether you put it in a corporation or not, it's not going to save you tax. In fact, if you put a rental property in an LLC and you elect it to be taxed as an S corporation, you could actually be triggering a much larger tax liability implication than the latter. Meaning that when you convert an LLC to a corporation, you are converting your $500,000 property. Let's say that's what it's worth. You're converting your $500,000 property into $500,000 of shares of a corporation. You are essentially trading the property for equal value or par value of the shares of the corporation. Well, let's say that you own that property in that S corporation for the next 10 or 15 years. The property appreciates from 500,000 to $1 million. Well, when you decide to take that property out of the corporation, not sell it, let's say that you just want to take the property out of the corporation and hold it personally. Now the government views that as a share of stock, not a sale. You didn't sell the property, but because the company distributed an asset that has a basis of 500,000, now is worth $1 million. You actually, even though you didn't sell it, you actually pay capital gain tax on $500,000 at that point. And that's if you hold the property under a corporation. So for rental investments, only ever use LLCs. And have good insurance, obviously, because insurance and LLCs, they go hand in hand. They don't offer the same benefit. Insurance offers payout in case an unforeseen event happens. The LLC allows for asset separation from your personal assets. So you will absolutely need both. But there is never a time where you'd want to put a long-term rental investment into a corporation. If you are a property flipper, right? If you're rehabbing property and the government deems you a property dealer, property dealers on all of their short-term gains are subject to self-employment tax. And so therefore, converting your rehabbing business from an LLC to an S-Corp would absolutely make sense. Whether it was a conversion in December, whether it was conversion in June, whether it was a conversion in February, it doesn't matter what time of the year it is. If the numbers make sense, you absolutely want to make the election to be taxed as an S corporation. Even though you've gone all the way through this year into October as an LLC, we can backdate the S election to January 1st of this year. So don't think that you're just out of the, up a creek without paddles. It's not that you're going to have to spend 10 months as an LLC and then 2 months as an S Corp. We can actually make the election for the full calendar year of 2020. So there never is really a wrong time to do the conversion. It just depends on what numbers you're reporting on that year's tax return.
Awesome. All right. If you have a corporation, do you need to eventually take a salary from that corporation? And if you haven't, what is the max time that you haven't taken that salary in your corporation? Is there a trigger for an IRS audit?
Yep. So remember that what I mentioned earlier when I talked about the LLC and the subchapter S corporation, once you establish yourself as a corporation, whether it's a C Corp or an S Corp, you are no longer self-employed. So you cannot contract work with yourself. You can't pay yourself 1099. You can't just pay yourself a check out of the corporation and call it a payroll. You have to formalize payroll for yourself if your company has any net profit above roughly $1,000. So if your company has any sort of net profit, you are required to pay yourself a reasonable salary. Now, if you've gone years without issuing a salary, what you've been doing is you've been flying under the radar. I'm not saying that you can do that forever. I'm saying that you probably need to bring yourself on board and start issuing yourself a salary, because you are not self-employed anymore. You actually are a primary shareholder of a corporation, if not 100% owner of a corporation. And a person who owns 100% of a corporation cannot be a contractor. They have to be considered an employee, especially if the company is profitable. Okay. So I would suggest, timing wise, it's whenever your business starts to show a net profit on an annual basis. So let's say that it's end of October right now. Let's say your corporation, if you dial in the gross revenue minus your expenses, let's say that your company has a $20,000 net profit. You need to issue yourself by December 31st at least a 40% W-2 on $20,000 of profit. Okay. So like an $8,000+ W-2 needs to be issued to you before the end of the year. Now, some of you might be saying, well, I don't want to do that. Well, unfortunately, it's not an option. This is something that if the IRS were to ever audit your corporation, all of those years that you had never issued yourself a salary, guess what? You had never contributed your fair share to Social Security and Medicare. So if they find out that you've never issued a salary, they could do up to a 10-year audit on your corporation and assess a reasonable salary, which will not be 40%, because the government now determines your reasonable salary, and they'll force you to pay 10 years of back payroll taxes on wages that you never paid yourself, or however long your company's been operating that way. So don't play that game. Once again, there's a way to be safely aggressive, not overly aggressive, right? And you want to be safely aggressive. One thing that you've been missing out on just as of 2018, if you haven't put yourself on payroll, is something called the Qbi deduction. See, as a corporation, in order to qualify for the Qbi benefit, you actually have to pay yourself a salary. You actually have to put yourself on payroll. And that potentially could qualify you for 20% of your company's income to be received tax-free. That means that if your company made $100,000, that if you don't pay yourself a salary, you could be losing out on $20,000 of a tax-free benefit, because QBI has only been around since 2018. And one of the qualifying things that needs to happen is you have to pay yourself a payroll.
Yep.
So once again, a lot of moving parts.
Awesome. Do I need an entity to take advantage of the auto bonus depreciation?
You don't need an entity. You just have to be aware that if you don't have two vehicles and you only use one vehicle for both business and personal, you will not qualify for the 100% bonus depreciation if you're a sole proprietor with only one vehicle. It has the ordinary, necessary, and legitimate and reasonable nature. The qualifications have to be there, right? If I only own one vehicle, I can't make the argument that it's solely for business. I could make the argument till I'm blue in the face that I never leave my house ever. And the only time I ever leave my house is for business and to use that vehicle. At the end of the day, that's not a reasonable argument to the IRS, even though it may be true. Who knows, right? But at the end of the day, you got to look at what the reasonableness is in the deduction. If you purchase the vehicle for your business, whether you're a sole proprietor or not, and you have another vehicle that is solely used for personal use, then yes, that one business vehicle will qualify for 100% bonus depreciation if it's over 6,000 pounds. If it's under 6,000, you only get the $18,000 bonus depreciation. But once again, good conversation to have with your tax advisor, and also to plan ahead, to strategize, maybe to kind of navigate the rough waters of that part of the Internal Revenue Code, potentially to maybe buy another vehicle before the end of the year to qualify for the 100% bonus depreciation. If you're married filing joint, it's a little bit easier to play that game, right? If you're single, you actually have to have two vehicles in order for one to qualify as 100% bonus write-off for the business.
Awesome. How do I change my LLC interest to tenants by entirety?
To tenants by your LLC interest to tenants by entirety. I'm a little confused with the question. Tenants by entirety, is that a term that you're using, or is that something that you read in a book? Or because an LLC should only be owned by the managing partners or investors in your LLC. I'm not sure why you would ever convert your LLC or add your tenants to ownership of an LLC. So maybe I'm not understanding the question correctly. If they're going to be a little bit more.
Type in a clarification. We'll come back to that one. Do you work with note investors, Tony?
Absolutely. Oh yeah, we have a lot. Not only me specifically, but all of our senior consultants. We all have note investor clients. I have some clients who have notes in the millions of dollars. I have some clients who have very small short-term notes. we have clients who invest in it would take me probably a couple of days to list out all of the different types of investments our clients have, but yes, to answer your question, yes, we do.
Okay, perfect. Regarding the election next week, if we were to end up with a different president, do you see any future tax changes affecting the real estate industry?
You know what? I'm gonna have to
loaded.
ask that you bring me back for a webinar after the election, because I am not a speculator. As an accountant, I deal with numbers. I want to be exact. I don't want to give you any information, whether the pendulum swings left or right, until we know exactly the results of the election. Because even if Biden's tax code is put into place, I would put money on it right now that what he says is going to go into his tax plan won't be accurate. I mean, when presidents try to enact a new tax code, no, nothing. We're not talking politics here. I'm just saying that with Biden telling people what they want to hear now, with Trump telling people what they want to hear now, both sides trying to win. It's very much it's like a sport, right? They go to bat to win against each other, and whoever wins, right? And they become the president of the United States. But when the president is elected and they have this idea of what the tax code should look like, you have to understand that there's a lot of sludge in the tax pipeline that they have to push through in order to get all of that passed. And so once again, I personally think it should be illegal for any politician, any news station to talk about tax code. I think that there should be something that, I know that's a Fifth Amendment right to talk about everything, but at the end of the day, no one should talk about tax code unless they're a tax professional. Because a lot of the information about Trump's tax return, a lot of the stuff about Biden's tax plan, a lot of it doesn't make sense. There is no possible way. I'm telling you right now, and I could, once again, I could do a whole two-hour PowerPoint on Trump's tax return. I guarantee you that $750 amount, that might be his federal tax. But the general public doesn't know about alternative minimum tax. They don't know about corporate alternative minimum tax. They don't know that when you're a billionaire, you have very few things reported on your personal tax return. You have everything sheltered under corporations at multiple levels. And I guarantee you that Trump might have looked at his tax returns a couple times, but he pays hundreds of people like me to get him to pay less tax, just like all of my other clients do. They pay us to shelter income so that they can retain most of their wealth and not overpay to Uncle Sam. I didn't write the tax code. My clients didn't write the tax code. I know Trump didn't write the tax code. A lot of the tax codes that he benefits from, by the way, were put in place in the 1960s. The real estate active participation part of the tax code that allows real estate professionals to benefit from the tax code, a lot of those codes are as old as 1960. Trump was like 8 years old when those were put into effect. So once again, I don't think anybody should talk about taxes unless they are licensed to talk about it. There's a lot of misinformation, and that's why I'm sorry for going. I'll get off my pedestal now.
No, that's a great point, Tony. It's a great point because there's a lot swirling around. So great question, great point. Okay, so what about an Airbnb property? Hold it in an LLC or an S-Corp?
That's a great question too. Airbnb tends to run a much higher risk and liability, not only from a theft standpoint, but from a damage standpoint. People renting out your property for vacation use, throwing parties at it, having children or elderly parents staying in the house. So you run a much higher risk and liability with short-term investments than I believe than you do with long-term investments. So anytime you convert a valuable asset into a business asset, a personal asset into a business asset, or start to operate a business, you need to look at the risk and liability factor that you're dealing with. Who are you renting out to? For a perfect example, I have a lot of clients buying property in the desert right now, out in Palm Desert, in La Quinta, even in Palm Springs. I know that the desert has some very strict short-term rental requirements, but out in the desert, you have golf tournaments, you have tennis tournaments, you have the music festivals that didn't happen this year because of the pandemic, but they'll be back. Don't worry. I mean, all of this stuff will return once the pandemic is over. Everybody will get back to business as usual. We're already starting to see a little bit more of that, but they're buying in these places where people will come out and rent for a weekend. And we would be very ignorant to think that eventually somebody's going to rent it out, or that this will never happen, that somebody's going to rent it out and throw a party at your house, right? Or have loud noise or music in the background, or a child that gets injured because you didn't fix one of the front lawn sprinkler heads and they fall and they hit their head and they're hospitalized. I mean, there's a number of things that you could run into with short-term Airbnb investments. Imagine dealing with 50 different personalities in a job that you don't even really actively participate in. That is a short-term investment. So to answer your question, I absolutely would say that if you have any equity in your property whatsoever and you are turning it into a short-term investment, that you absolutely take advantage of not only a finely tuned bulletproof insurance policy, but also put that property into a limited liability company. Absolutely. Long-term rental investments, depending on who you rent out to. I mean, if you're renting out to a single person, maybe a college student who's in law school, let's say, I mean, you're probably not going to have very much risk and liability with that one person, especially if it's a 1 or 2 bedroom place. But if you have a 4-bedroom, 5-bath home or a 5-unit building with 5 different personalities, even if they're long-term rentals, you still run a pretty high risk and liability in that, because there's children involved, there's multiple personalities involved, there's, economic recessions and pandemics that might throw people into a situation where they can't afford to pay you rent. So yeah, you want to separate your business assets from your personal assets at every corner, especially if you have equity in those investments. Those are cash flowing businesses for you. Why would you not want to separate them from all of your other personal liabilities? So yes, the answer to the question is yes.
All right, so the term tenancy by entirety refers to a form of shared property ownership that is reserved only for married couples. A tenancy by the entirety essentially permits spouses to jointly own property as a single legal entity. This means that each spouse has an equal and undivided interest in the property.
So joint tenants. I mean, that's essentially what joint tenants is. So you can be on title with a spouse and only file one Schedule E. So instead of having a 1065 partnership, if you and a spouse own a property and you're legally married and you're filing a joint tax return, you do not file a separate tax return for that partnership. You file a single Schedule E on your individual return that's reported under both of your social security numbers. Now, could you put it under an LLC and make it a limited liability partnership? Sure, you could, but if you're married, why would you want to do that? Then you add a tax filing fee, you add a second tax return, you add a filing requirement with the state and the federal separate from your personal return. So there's a lot more involved in an LLC multi-member partnership. For a married couple, you can be an LLC, a disregarded entity, where you actually file still on your personal return, avoiding the second filing, and you just supplement California with their $800 filing fee. And at that point, it's a joint tenants kind of situation with your spouse, but also having the limited liability protection of an LLC. So I don't know if that answered your question, but I think that what you're just referring to is joint tenants with a spouse. I mean, you could file that in a couple different ways. I would never want a spouse and like 2 individuals to own a limited liability partnership unless they had other partners involved in that investment. An LLC is perfectly fine in that specific situation if it's a married couple.
Okay, hopefully, Roger, that answered the question.
And if it does, sign up for the free consultation and we could talk in a more formal setting.
Yep. Perfect. All right. Last question. Wendy asked, can you explain QVI again? And is it QBI or QVI, Tony?
It's QBI as in boy. So qualified business income deduction, qualified business income deduction. And essentially this is brand new as of 2018. It's only about 2 years old. And this states that if you are married filing joint, or if you're single and you are under the income threshold that allows, I think it's I would have to look up the thresholds again. I think it's 231 or 236,000. No, I'm sorry. 326, I'll have to look up the thresholds, but as long as your adjusted or taxable income is under one of these very high thresholds, that you and your spouse or you individually could qualify for a qualified business income deduction based on your net revenue through your rental properties or your self-employed business. Let me give you an example. Let's say that I'm married. My wife is a self-employed real estate professional. I'm an employee. Let's say that I'm making $100,000 in W-2. My wife is making $200,000 in self-employed income. Because overall our taxable income is at $300,000 to $326,000. I think that's, no, I'm sorry, $321,000. That's the threshold that we need to be under for married filing joint. So because we're at $300,000 of overall income, or that would be our taxable income, we're under the 321 threshold, which means that we qualify for QBI. But out of this relationship, who has the business income? Not me. I'm an employee. So my income does not qualify for QBI, but because my spouse is self-employed and makes $200,000 in net profit per year, and we're under that threshold, we qualify for QBI, which makes 20% of my wife's income tax-free. Well, what's 20% of 200,000? That's $40,000 of tax-free income that we qualify for under the 2018 tax reform. So once again, and I mentioned this in earlier webinars, and I should mention it in every webinar that I give, that even though there might be a limit on your property taxes, even though there might be an adjustment to your mortgage interest, even though there might be other things that have impacted you kind of a negative way, reduced refunds or increased liabilities, understand that there might be another piece of the puzzle that actually makes up for the loss in benefit over here and kicks you into having even a larger refund because of something like the QBI deduction. So it stands for Qualified Business Income Deduction, and you have to qualify for it based on your taxable income. And that makes all of the business income subject to a potential 20% tax-free benefit.
Awesome. All right. And this is the last question, everybody, because we're over time with Tony. He's been very generous with giving extra time to us. So if you have questions, please go to roberthalltaxes.com/consult, get that free 30-minute consult. Let them know that you were on this webinar. Again, they like to see, you know, where everybody's coming from, and that we're doing a good work here and we're reaching people. So Julie asks, last question of the day, should the LLC flow to your S-Corp LLC? S-Corp LLC? I'm confused. Should the LLC flow to your S-Corp LLC for short-term rentals?
No, you want to, once again, the whole point of incorporating is to separate all of your assets. So having the LLC owned by your S corporation would be putting eggs into one basket, in my opinion. When you ask, also just as a side note, when you talk about the legal benefit of all of these entity structures, you absolutely want to talk to a legal advisor about this. I'm a tax preparer, so I know how it all works tax-wise. And even though I know a lot about the legal side of it, I'm not licensed to advise you like an attorney is. So when you need more information about the legal aspects of entity selection and asset protection, definitely talk to an attorney about that. But for just from a bird's eye view, you don't want things flowing to each other, because then if your corporation, if your S-Corp is ever sued and somebody is able to pierce that corporate veil with a charging order here in the state of California in a court of law, they could come after all of the business ventures that the S corporation invests in. They could come after all of the revenue streams, right? So having everything separated is the best option. Having your properties in LLCs with you, the owner, or your living trust, the owner, then having your corporation flow through to you personally, but owned by your living trust. I mean, the levels of entity structuring, you could get really crazy with a lot of the different structuring positions. But these are great conversations, once again, to have with a tax advisor, also to have with an attorney. But to answer your question, no, I would not suggest having your LLC flowing to your S-Corp unless an attorney suggested that. Once again, from a tax perspective, it's not going to make a difference. But from a legal perspective, you absolutely want to run that by an attorney.
Awesome. Great questions, everybody. And thanks so much for hanging out with us a little bit later. Tony, thank you for staying a little later and providing just such valuable information, for my tribe, my peeps. Really appreciate your contribution today. As everybody knows, anybody who knows me knows that I try and bring such value to help people in their situation and get the best possible information that's out there. And I consider Robert Hall to be one of those resources for the best possible information out there. So everybody, please book your appointment with them. They will not steer you wrong. They're a great group of people, and I've enjoyed getting to know them over the course of these years. Definitely. Also, really quick announcement. Don't forget, everybody, if you are interested, we have a few seats left for the Building Wealth with Notes workshop that is coming up. I can't believe it's next week, next Friday, November 6th through the 8th. So you can, we talk a lot about building your wealth with notes, and that's the start off point. And Tony can really help you diversify that and help with the note income that comes in, because we are in a place that, boy, we are really going to be seeing some incredible opportunity, and I don't want you to miss it. So don't sit on the sidelines and a year from now say, God, that could have been me. So looking forward to it. All right. Thanks, everybody. Have a great rest of your day. You will get this recording. Tony, thank you. And we'll, everybody, bye.
Great. Take care.
Bye-bye.